Welcome, and thank you for joining me for this weekly episode of Market Whispers. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, February 9th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, my market analysis, from the active chat line during trading hours, and from this podcast. Most recently, I wrote to my paid subscribers about the best AI stock that I picked for 2024, a company that's on track to become the next NVIDIA. I also wrote to them about my updated 2024 investing plan, which is predicated on my updated macro outlook and market roadmap for the year. In the previous podcast episode last week, I walked you through my updated macro outlook for 2024. And coming up, I have a new feature that I'll be publishing on a regular basis. It's called Beachman's AI Tracker. In this new regular feature, I'll be tracking the business performance and real AI revenue results and potential for a whole host of companies that say that they are developing AI-specific solutions. What I'm going to be trying to do is to separate the real AI beneficiaries, the real AI companies, from those that are posing as AI companies just to boost their stock price. So please consider becoming a paid subscriber. Tell your friends and family, and I'd love to have them and you join the growing Beachman community. Now on to the meat of this podcast episode. Let's start by talking about the current state of the markets. As of this morning, markets remain at all-time highs. The Dow Jones Index, the S&P 500, as well as the Nasdaq are still hovering at close to or at above all-time highs. Now, markets move up and down every day. Stocks move up and down every day. Some people check their stocks and their portfolio every day, multiple times a day. I'm also guilty of that. And the question that comes up is, does an investor really need to check in so frequently? Do we really need to check whether our portfolio went up or down 1 or 2% every day, multiple times a day? The answer, as you might have guessed, is probably not. We really don't need to check in unless there's a major event, unless there's a big company event, an event for a stock that we own, or a big geopolitical event or an economic event. That's why here at Market Whispers, we check in on the markets about once a week. That's probably more than enough for most investors. And we do that because we want to know if we need to take some action as a long-term investor. We want to know whether we need to tweak our portfolio based on any major events of the week. Now, some of the actionable information that we get regularly are macro updates. And this past week, we got a couple of very interesting leading macro indicator updates. We got the January ISM Manufacturing Index. That update for January came in at 49.1. This was well above December's 47 reading and November and October's 46 reading. So this seems to be an encouraging upward trend in manufacturing activity in the US. Now we want to see it get above 50 for it to be actually actionable. But this upward trend is definitely something that we've been on a lookout for at least a couple of years now. The other interesting thing in that macro report was that new manufacturing orders as compared to inventories grew for the first time in months. What this means is that companies are getting, that factories are getting way more new orders as compared to the inventories that they have built up over the last few months. Again, another encouraging trend. But we will wait for it to get above the 50 mark for it to be actionable as investors. We also got the January ISM Services Index report this past week. That also showed a strong rebound for the month of January. January was up to 53.4. That was versus a 52 estimate and a 50 reading from the prior month. There too, new orders were up to 55 versus 54 and 53 prior. So services is also rebounding or showing some sort of rebound in January after dipping in the month of December and prior. So we've got two leading macro indicators, manufacturing and services, showing some sort of rebound for the month of January. Several rail and trucking companies in the transportation sector also saw a recent rise in activity and orders for their transportation services. Apparently, this was predicated on a stronger than expected holiday shopping season, and we'll have to see whether this trend continues in the transportation segment. So we'll continue to monitor these macro updates as they come in. Like I've mentioned before, I prefer leading macro indicators, and the ISM manufacturing and services indexes are two of the leading macro indicators that I follow. We're also in the thick of the Q4 earnings season, and we're currently slightly past the midpoint of the fourth quarter earnings season. Overall, the performance of the S&P 500 companies as compared to past history continues to remain subpar. The percentage of S&P 500 companies reporting positive earnings surprises remains far below the historical averages. At this point, more than 50% of the companies in the S&P 500 have reported their Q4 earnings. And of these companies, only 72% have reported earnings above estimates. This is far below the 5-year average and far below the 10-year average of such companies reporting earnings above estimates. Even in terms of the actual beats are also much lower than the 5-year and 10-year averages. Companies that are beating estimates are only beating by about 2.6% above estimates. This is almost 2/3 or 3/4 below the 5-year and 10-year average of beats. We have seen positive earnings surprises from companies in sectors like healthcare, technology, energy, and consumer discretionary. But we've also seen negative earnings reports from companies like financial services, industrials, commodity chip makers, and small cap stocks. So as investors, when we hear these Q4 earnings reports, and more importantly, as we get guidance for the rest of the year from these companies that are reporting, we have to ask ourselves a question: what is going to happen to the markets based on what we've learned from these recent earnings reports? Well, according to Argus Research Company, they have studied stock market returns on a monthly, quarterly, and annual basis using data since 1980. According to Argus Research, they believe that February is not one of the best months of the year. On average, in the month of February, stocks have risen less than 0.1% during the shortest month of the year. According to Goldman Sachs Research, the second half of February is the weakest 2 weeks of the year. They have used data since 1928. Goldman also said that the first half of September is the second weakest 2-week period of the year. The first half of July is the strongest 2-week period, and the second half of December is the next strongest 2-week period. So we have to be cognizant that even though markets are at all-time highs or hovering close to all-time highs, we are soon entering into the weakest 2 weeks period of the year, which is the second half of February. So investor beware, trader beware. And continuing our theme of learnings from the recent Q4 reports, today I wanted to discuss a couple of companies that did report recently. One of them is a cloud stock that I believe got away from my portfolio. This is a cloud company that has established a vast global online presence. They process back-end operations for some of the largest companies in the world and across multiple industrial sectors. Now, if you like tech and cloud and are still risk averse and are looking for a mature cloud stock offering, this is the company that you might want to consider. The company I'm talking about is called ServiceNow, ticker NOW. ServiceNow supports more than 7,700 global customers in almost all industrial verticals, to digitize their businesses from top to bottom. They provide a scalable, customizable cloud platform that can be used to run and manage a company's end-to-end workflow and operations. They sell modules like service management, operations, asset management, security, customer service, customer management, and employment management. They remind me of Monday.com, but on a much larger scale. Looking at their 2023 results, which they recently reported, they generated more than $9 billion in revenues, and revenues are growing consistently at about 23 to 25% on an annual basis. Their gross margin is very high at 79%. Their margins have been expanding and continue to expand. They also have expanding cash flow margins. Their business pipeline in terms of RPO just grew 29% quarter over quarter. Their large customer count also grew 6% quarter over quarter. And their retention rates are some of the highest in the industry, consistently at 98 to 99%. They have a healthy balance sheet with low debt to cash ratio. They have a share buyback program. Morningstar just bumped up their fair market value from $640 all the way up to $770. And their institutional ownership continues to expand as well. So ServiceNow is one of those very attractive, consistently growing cloud companies that I like. But unfortunately, I didn't pull the trigger on them when I had the opportunity. Now, there are some risks in investing in ServiceNow. One of the biggest questions I have is, do they have any major new markets into which they can expand? They sometimes seem to be reaching some sort of saturation point in terms of new markets and new global customers that they can target. Their large customer growth has been pretty flat for the last several years at about 4 to 5%. Now we have to remember that this growth is on a fairly large base in terms of number of large customers, but it's still pretty flat as compared to other large cloud companies that are still growing at much higher percentages as compared to ServiceNow. They're already in most of the sectors and geographies around the world. The easy pickings have been taken. And now there's a lot more competition nipping at their heels. Companies like IBM, Accenture, and Capgemini that are trying to emulate ServiceNow's cloud platform and cloud-based online services. On the other hand, ServiceNow is perfectly situated to benefit from the recent developments in the AI arena. They have been embedding generative AI capabilities across their cloud platform to improve the productivity and efficiency of their user community. They have co-pilots, they have assistants, they have virtual agents built into their cloud platform. And given that they are in the business of automating the end-to-end operations of a company, these kind of co-pilots and virtual agents and assistants are perfectly set up to improve productivity for their user community as they use their online services platform. Now, I regret not buying ServiceNow almost 8 months ago when it was hovering at around $350. That's when I first put it on my radar screen and on my watch list. And I held off investing into the company at that time because I had concerns about a possible recessionary slowdown in 2023. Well, as we know, that mythical recessionary slowdown did not show up last year, and ServiceNow as a stock got away from me. ServiceNow is closely tied to the health of the US and global economy, and we know that the other risk is that any macro slowdown will negatively impact their business prospects. But this is the one that got away from me. I deeply admire the company, and if I do get an opportunity to get back into them, I will take that opportunity. The other company I wanted to talk about today was Meta, that was previously known as Facebook. Now, you may have heard that Meta recently reported their Q4 earnings report, and the stock jumped up more than 20% in one day. This was the largest one-day increase in any stock ever in the history of the US stock market. Now, here are my thoughts on Meta's monster quarterly report. Yes, That was a monster quarterly report. Meta has become a very strongly performing business, and that report has to be respected and admired. They have moved into a completely different stratosphere as compared to their peers like Snap and Pinterest, etc. Meta has clearly moved well above their peers in terms of business performance and the ability to generate growth, profit margins, and cash flows. Meta today has expanding margins, expanding cash flow margins. The cash on their balance sheet is increasing on a regular basis due to real free cash flow generation. Morningstar upped their fair market value to $400. I believe that the stock now trades somewhere around $450 to $460. Institutional ownership of the stock is increasing, and there's a lot more to love about the company in terms of their future prospects. Now, in terms of risks, I did notice that their debt is rising faster than it used to. Meta's capex spend continues to increase. I believe last year they spent over $30 billion in capex. This year in 2024, they're expected to spend almost $40 billion on capex as they continue to build out the AI and metaverse cloud infrastructure to support their current and possible future products. Their forward revenue is due to slow down in the rest of 2024 and particularly in 2025. Their daily average user counts, or DAUs, have remained stagnant at about 2% growth year over year. Almost 10% of their business, their ad business, comes from China. And as we know, China's economy is slowing down and getting into a deflationary situation. So that is definitely a major risk for Meta going forward. And if we talk about AI, Meta's AI revenues today are almost non-existent. And there doesn't seem to be a point, at least in the year 2024, where even they believe they're going to have substantial AI revenues. So if I'm looking for a strong ad tech company, then Meta certainly makes sense. If I'm looking for a good AI company, then Meta is not worth considering in my opinion. Given that they are spending $30 to $40 billion on capex, I believe that this kind of spend benefits other companies. Stocks like Nvidia and SMCI will benefit from Meta's AI spend. So if I'm looking to invest in the AI tailwind, then those are the ancillary stocks that I would consider investing in instead of investing in Meta at this time. This is exactly the type of AI tracking analysis that I am going to be publishing to my paid subscribers on a regular basis going forward. It's my intent over the next 12 months to dive deeper into companies like Meta that talk about their AI work and their AI business potential. It's my intent to actually dive deeper into what exactly they're doing to identify whether it's investable as an AI investor, whether they're actually generating AI revenues, or whether it's mostly going to be AI investment to support other aspects of their existing business. Finally, we'll wrap up with what's coming up in the market. Next week, on Tuesday, February 13th, we're going to get the next CPI retail inflation report for the month of January. On Friday, February 16th, we're going to get the next PPI or wholesale inflation report for the month of January. I expect both these inflation reports to continue to show a downward trend in inflation rates for the US. So nothing really actionable as an investor, at least that's my expectation. So that's all I have for this episode of Market Whispers. Drop me a comment or question anytime. I love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest. For life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.